Hello, everybody. This is Gary Mrozinski, and welcome to Chapter 7 of The Microeconomy Today by Schiller and Gebhardt, published by McGraw-Hill. This is a very important chapter. We just spent 2 chapters on the demand side of the market, discussing concepts of consumer behavior. Now it's time to talk about the supply side of the market. And what we're going to do is talk about how business firms behave, how they make their economic decisions in different types of market structures, where what is varying is the level of competition. So this is what we're going to be working on in the next 5 or 6 chapters. So what I mean by market structures are, it could be a market structure where there's no competition, just one seller. That kind of market structure is called a monopoly. Or it could be the kind of market structure where there's more than one, but there's only a couple sellers, or at least a couple sellers that have the majority of the market share. That's what's known as an oligopoly. That's a little bit better for the consumer than monopoly is, but it would be even better if there were lots and lots of sellers of the product. That is monopolistic competition. Most of the markets in our economy are monopolistic competition. And then even better than that for the consumer would be if there's hundreds or even thousands of sellers of the product. That's what's known as pure competition. We're going to talk about each of those 4 market structures, but before we do that, Chapter 7, the costs of production, what you learn in this chapter applies to each of those other market structures. Okay, costs of production, here we go. We know that it's the overall objective of any business firm, if they're a for-profit firm, to maximize profit. Profit equals total revenue minus total cost. In this chapter, we're going to focus on total cost. We're going to break down cost, we're going to be graphing costs, and we're going to be adding those cost curves to the demand curve, which is from which the revenue is generated. And you're going to get really used to graphing these curves. We learned in Chapter 1 about this thing called opportunity cost. An economist considers not only explicit costs, which can be measured by dollars, and an accountant would be tracking explicit costs, but an economist also considers implicit costs, opportunity costs. These are the costs of everything you're giving up when you take a certain course of action. And so the example I gave you in Chapter 1 was, imagine that you are graduating from college with your 4-year degree in business administration, and you're trying to decide whether to stay in school for 1 more year. And let's say your college or university has a special deal for alumni where it would be $15,000 in tuition for 12 months, and that would be long enough for you to get your Master's of Business Administration. Of course, you'd have to be a full-time student, and you couldn't work for that year because you'd be so busy working on these graduate courses. So what is the total economic cost of that MBA? Well, the explicit costs would be $15,000, but an economist also considers the implicit costs, the most notable of which would be foregone wages. You would be giving up the opportunity to go to work and earn, say, $50,000 that year working full-time in a job and starting your career. So you're giving up that opportunity. So the total economic cost would be $15,000 plus $50,000, or $65,000. When you're trying to make that decision, you need to consider all of the costs, explicit and implicit, and you still may decide to do that because of future earnings potential, but still you need to know what the total economic cost is. So here it is. Economic costs equal implicit costs plus explicit costs. Explicit costs, again, are costs that are monetary payments that an accountant would be tracking. They're very obvious. Implicit costs, sometimes you have to think about them a little bit. They also include any of your own resources that you're using in your business if you're starting a business, for example. And again, explicit costs can be identified by an accountant with a paper trail denominated in dollars. implicit costs are the cost of resources for which no payment is made, and so they're oftentimes estimated, but you do need to account for them and include them in your economic costs. We're going to spend time talking about this in the next couple of chapters. Now back to the costs of production. It's important to understand the costs of production because in order to minimize costs, which would be the goal if you're trying to maximize profit, it's important to understand costs. And we're going to delve into costs from this point on. Specifically, we'll look at how much output can a firm produce, what is their capacity, how do the costs of production vary with the rate of output? It varies, and that's a very important concept. And what we're leading to is eventually, for each of the business firms and each of the four market structures, we're going to try to figure out what is the perfect level of production, the number of units per week to produce in order to maximize profit. It's dependent upon your costs at each of those levels of output. And do larger firms have a cost advantage over smaller firms? I think you know the answer to that, but we're going to talk about that analytically and graph that to illustrate it even more clearly. Your textbook makes the point in this chapter of addressing the fact that not all resources are created equally. Some resources are of higher quality than others, and we're going to be speaking mostly about labor resources in this course. That's what economists do mostly. You talk about labor resources as a variable resource. And so here's an example of how two different laborers, workers, employees can vary with regard to their quality. And how would we measure quality? By productivity. One person could be being paid $10 an hour and type 90 words a minute. That's cheaper than paying someone else $2 an hour who only types 10 words a minute because of the different levels of productivity, the different levels of quality. The production function. This is where you show the amount that could be produced by, let's say, a department as you vary the number of workers in that department or number of labor units used. So you could actually vary labor hours in that department, or you could look at it the way we're going to address this in this chapter, at least in the beginning, is we're going to vary the number of workers. Add one more worker, well, now the department or unit can produce more per day. Add another worker the next day, and output should increase. The production function tracks that. It shows how the total amount produced by the business firm or by a department within the business firm, how it varies depending on the number of labor inputs, number of workers that are working. We're also going to make the distinction between the short run and the long run. This is coming up in a few slides, but it's important to mention here too. When you're adding workers are considered variable resources because you can easily add workers or add labor hours, have workers work more hours or offer that to them. That's something that varies with output, right? You would do that because you want to produce more. In the short run, you don't have time to vary your fixed plant. Your building is your building. Whatever the size is, the size is. The major fixed automation and equipment that you use to produce your product, that's your capital. You don't have time to vary that in the short run, it is assumed. So those are your fixed resources. You can vary your variable resources, but not your fixed resources in the short run. And the production function understands that. So to produce, you need land and capital and also labor. Land and capital are your fixed resources. They're your fixed plant in the short run. And workers, labor, that's your variable resource. And there's other variable resources, but we're going to be addressing workers mostly as our variable resources. So you have a fixed plant, your land, your facility, your major equipment, your fixed equipment, and then you're going to be varying the number of workers and then measuring how much those workers can produce in that fixed plant. And you would increase the number of workers if you wanted to increase output. And so again, the production function is showing you the total amount that could be produced for any number of workers that you might add and use per unit time. We will be considering the production function in the short run. How much is produced given a certain number of workers in the short run. So our fixed plant is fixed. You can only vary the size of your fixed plant in the long run. So you might be asking, well, how long does it take to get to the long run? What's the period of time that constrains us in the short run? It depends on the industry. If it's heavy manufacturing, like aircraft manufacturing, where they need huge warehouse-like facilities with high bay areas and very expensive automation and equipment, it could take a couple of years because you've got to get the funds in place, and then you've got a plan, and you've got to have it designed, and then contracts to build the thing. Even to add on to an existing facility could take a couple of years. When I worked in healthcare, it took us a couple of years to do a major project, even a major renovation of an existing facility. It took 1 to 3 years to line up the funding, hire the design engineers, and then hire the contractors, and the work is usually phased. So that's in some industries. Automobile manufacturing is another example, heavy manufacturing. But there are other industries where you can, let's say retail, you can scale up a retail facility in probably less than a year. So the difference between the short run and the long run may be 1 year. So it depends on the industry is the point. So in the short run, you have variable inputs such as labor, number of workers, labor hours, plus raw materials, that's a variable resource, fuel, power, all of this varies directly with the amount that you're producing. And then again, your fixed plant is your capital. In the long run, all resources are variable resources, all inputs are variable. You do have enough time to expand your facilities. And we'll be addressing the long run at the end. So everything from this point forward, we're going to be addressing the short run, and then I'll make it clear when we're moving into the long run. So here are some definition of terms, again, in the short run. Total product is the total amount produced for a certain number of resources that you're using, a certain number of workers. A certain number of workers are producing a certain amount of output per unit time. That's the total product. Total amount produced per unit time. So that's Q. We've been graphing Q on the x-axis. We're going to now be graphing Q on the y-axis, on the vertical axis. Marginal product is the amount that your total product changes when you change the number of workers. If you hire one more worker, or if you remove one worker, then your total product is going to decrease. It's the amount that total product changes when we're always going to be adding workers and seeing what happens. So if you're producing so much per day with your current workforce, and then tomorrow you're going to hire a new worker and have that new worker working, your total output's going to increase by some amount. That's the marginal product of that extra worker you just hired. Average product is when you take total product and divide by the number of workers, or the number of units of labor in general. Now, marginal product is going to be more important to our analysis than average product is, and I'll explain that. Now here's an example I like to use. This is not the example that's in your textbook, but it's a good introductory example of how the production function works, okay? So in this example, Farmer Jack runs a farm. He grows wheat. He has 5 acres of land to work with. So the 5 acres of land, that's his capital. So this is a very simple example. He can hire as many workers as he wants. Those are his variable resources. So as he hires one more worker, the total amount of wheat he's producing in a month will increase. And if he hires one more worker, it will increase yet some more. So that's what we're going to be doing here. Here is Farmer Jack's production function. So across the x-axis, you can see is the number of workers that he might be hiring. And then the y-axis, that's Q. That's the amount that the workforce is producing, that his farm is producing per unit time. And I think we're going to be doing per month. Yes, this is bushels of wheat per month. So look at the table on the left first. So if he has 0 workers, he's producing 0 bushels of wheat per month. Let's say he's going to start with just 1 worker. Well, his farm will be producing 1,000 bushels per month. And that's month after month after month. And let's say that's happening, and now he's considering hiring a second worker. Okay, now he hires the second worker. Well, this is his production function. And now the farm is producing 1,800 bushels of wheat per month. Okay? And let's say he's doing that for some number of months, and then he's thinking about hiring that third worker. All right, now he hires the third worker, and now the farm is producing 2,400 bushels of wheat per month. So, does this make sense to you? Does something look a little funny here? Let's go back to when he increased from 1 to 2. When he had 1 worker, the farm was producing 1,000 bushels of wheat per month. What were you expecting when he hired the second worker? I'll bet you were expecting total output would be 2,000 bushels per month, right? But it wasn't. Remember what marginal product is. Marginal product is the amount that total output increases when you hire 1 more worker. That's the marginal product of that worker you're hiring. It's the amount that hiring him will contribute to total output. All right, so the marginal product of the second worker is 800 bushels per month. That's how much is being added to total output. And then when you hire the third worker, we go from 1,800 to 2,400. What is the marginal product of the third worker that you hired? It's 600 bushels per month. Marginal product decreases the more you produce. The more you produce, the more workers you must need to be hiring. And marginal product is decreasing with each worker that you're hiring. All right, when you go from 3 to 4, if you have 3 workers, you're producing 2,400 bushels per month. You hire the fourth worker, now you're producing 2,800 bushels per month. The marginal product of the fourth worker is only 400. And then the marginal product of the fifth worker, if you were to hire that person, is 200. So the question is, why is marginal product decreasing the more workers you hire? Total output increases, which you would expect it to do, but by smaller amounts the more workers you hire. So this is just explaining what I just went through. Marginal product is the increase in output arising from an additional unit of that input, the input being labor in this case, hiring 1 more worker, holding all other inputs constant. Of course, we have to say ceteris paribus, right? If nothing else changes but we hire 1 more worker, total output will increase by this amount. That's the marginal product. Oh, by the way, your textbook calls this marginal physical product. It's the same as marginal product. You might see me refer to this both ways or either way, one way or the other. They're the same thing. Marginal physical product is the same as marginal product. And it is, you can see an equation at the bottom there, the change in Q when L changes. L means labor. Labor inputs, however you're measuring that. Could be labor hours, could be number of workers. We're using number of workers here. So if you increase L by 1 more worker, so then in the denominator would be 1, that results in some amount of increase in Q. That's what goes in the numerator. So if you're increasing by 1, then the marginal product is just the change in output. If you're hiring 3 more workers, don't forget to put 3 in the denominator. You see what I mean? These are very simple examples. A real, large-scale business wouldn't be hiring 1 more worker. They'd be hiring 10 more workers if they need to increase output, or maybe 100 more workers and looking for output to increase by some amount. In those cases, you need to put 100 in the denominator, or whatever the increase is. This is the same table. The first 2 columns are the production function. And now you can see the change in Q. And since the change in L is 1 each time, then there's a new column on the far right. That's the marginal product. So as we go from 0 to 1 workers, the marginal product of the first worker is 1,000. We went from 0 bushels to 1,000 bushels per month. The marginal product of the second worker then is 800, etc. And you can see it's added in here. So this is a function that is, here's a review of your math background. If the graph is going uphill, then that is an increasing function. If it were going downhill, like the demand curve goes downhill, that's a decreasing function. All right, so this is clearly an increasing function, which makes sense because you're adding more workers to go from left to right. You would expect output to increase, but it increases by a decreasing amount. Do you remember how that works? If it goes uphill but is leveling off, it's going up by smaller amounts as you go from left to right. That is a function that increases at a decreasing rate. And that's what's happening here. So total product increases at a decreasing rate because the rate is the marginal product and marginal product is decreasing. So why is marginal product important? And I told you it's more important than average product. Average product would be if you divide the total amount produced by the number of workers. It's more important to think about the marginal product because you are operating with some number of workers. Maybe it's 3. You're thinking about increasing output, so you would need to hire one more worker. The decision whether to hire that next worker depends on how much output will go up. And we didn't get to this part yet, but then you can place a value on that output. Just multiply by the price because you're going to sell it for some price. And then compare that to the cost of that extra worker. This is where we're going with this. That's what you think about. You don't necessarily think about how much is produced per worker. I mean, you do, and you do track that. You do use that in other kinds of analysis, but you don't use that to make the decision whether to hire that next worker. You make that decision. This is what's called marginal analysis. You make that decision based on the marginal increase, the increase in total output that worker will bring to your production. And then you compare that to the cost of that extra worker. So Farmer Jack's output rises by smaller and smaller amounts each time he hires another worker. That doesn't mean he shouldn't hire the worker. He should hire the worker if he wants output to increase. And we're going to get to eventually, well, how many workers should he have and how much output should he produce? That's where we're going. That's sort of by the end of the chapter, we're going to be at that point. Right now, we're just trying to understand the production function. So why is it that each additional worker is adding less to total output, even though it's going up? Well, this is the law of diminishing marginal product, or the law of diminishing marginal physical product if you prefer. I prefer to call this the law of diminishing returns. All of these are the same thing. Some textbooks say law of diminishing returns. Some say law of diminishing marginal product. It's the same thing. As you increase output, and the only way you can do that is by hiring more workers, output will increase by smaller amounts the more you're increasing your inputs. The reason for that is, remember, this is the short run. You have a fixed plant. You have a fixed facility. In this case, it's land. It's 5 acres of land. The more workers you hire to farm that land, the less land each worker has to work with. And it's not just land. It's going to be, the whatever farm equipment they have. They're going to be sharing farm equipment. They're sharing the land too. And what happens is the average output per worker goes down. At this point, you might want to think of a different kind of an example. Whatever room you're in, maybe you're in your house or in your dorm room, imagine that were, or maybe expand it. Maybe think of the whole floor, the first floor of your house, or the first floor of your dorm building. Imagine that is some sort of a factory and you're producing some product and you have machines that workers need to use to produce that product. And that's your fixed plant. All right? So you're adding workers. You're going to start with some size workforce. Imagine that you double that workforce. Well, now it's starting to get a little crowded in there, right? And the variable resources have less capital per worker to work with. It's getting crowded. They're bumping into each other. It's not just workers. It's other variable resources too. Maybe it's some sort of carpentry shop. You're producing chairs, wooden chairs. Well, now you've got these major equipment that people have to use to produce the chairs, and they need to wait, and they're waiting in line to use the equipment, and the workers are bumping into each other, and it's not just the chairs, but it's all of the wood and all of the other materials they need has now doubled because you're increasing output. You have doubled the amount of variable inputs, variable resources in that fixed plant. You're going to increase output per day, but by smaller amounts the more workers you hire. Maybe you're going to hire 2 more workers. Well, output's going to increase, but it's getting more crowded. This is what happens in the short run. Your fixed plant will eventually constrain you and lower the output per worker. That's the average product. Even though that's not what we use to make our decision, that is happening. What you do is you think about, if I hire 1 more worker into this facility, output's going to increase by some amount. How much is it going to increase by? That's what you use to make the decision. That's the marginal product. So here it is, the law of diminishing returns, aka the law of diminishing marginal product. We're going to assume the resources are of equal quality. We're going to assume that technology is fixed, meaning the capital that you're using, the technology, meaning the production technology, is fixed. It's not advancing. Now that is something that advances all the time, but we're just freezing that variable for now, just to understand this. As successive units of a variable resource, such as labor, number of workers, are added to fixed resources, like your facility and the equipment, and the land, beyond some point, the marginal product will fall. It will diminish. The law of diminishing marginal product. As the firm continues to hire additional workers to work with a constant amount of capital equipment, output will eventually rise by smaller and smaller amounts. Now, the word eventually is in there. What this means is, in the beginning, you might see an increase in returns. Marginal product might actually increase at very small levels of output. So, again, think of wherever you are right now, think of that as being some sort of carpentry shop, and maybe you have 4 major pieces of equipment that workers can use. If you have only 2 workers producing a very small amount of output, and then you increase that to 4 workers, you might actually see an increase in marginal product because now you have 1 worker for each machine. But that's a very small amount of output, and we're going to learn as we go that you never would really produce at that low level of output because you're not paying for the capital that you're using, the expensive capital. But in the very beginning, at small levels of output, you might actually see increasing returns, marginal product increasing when you hire 1 more worker. But then beyond some point early on, this is going to happen. Marginal product will increase by smaller, or it will diminish. Output will increase by smaller amounts. Marginal product will go down the more workers you hire. So what's the rationale? Why does this happen? Here's another way to think about it. This is now a different example. This is not Farmer Jack. This is Farmer Jim. He has 80 acres of land to plant in corn. If he does no cultivation, so that's going to be the how we're going to measure labor units. If he does no cultivation, he can produce 40 bushels per acre. If he cultivates the land once, so that's some number of labor hours, output rises to 50 bushels per acre. Okay, so the marginal product of that first cultivation looks like 10, right? If he cultivates twice, 57 bushels per acre. Okay, the marginal product of that second cultivation was 7. If he cultivates 3 times, 61 bushels per acre. All right, it's diminishing. Marginal product is diminishing. Succeeding cultivations will add less and less to the land's yield. If this were not so, in other words, if returns did not diminish, the world's needs for corn would be satisfied by an intense cultivation of Farmer Jim's single 80-acre plot of land. In other words, if the relationship between total output and number of workers were linear, meaning marginal product would be constant, if that were the case, then that means that your capital is not constraining you. And you can grow any amount of corn on an 80-acre plot of land. You can feed the world with that one 80-acre plot of land, if that were the case, but that's not the case. your fixed plant, your land, your capital will constrain you. And you can't just be adding more and more workers to this one plot of land and expect for output to increase linearly. It increases by smaller amounts. And here at the bottom, this was the example I was trying to get you to think about. Imagine a smaller scale example that would be like, as I said, the floor in whatever room, building you're in right now. Think about that one floor as being a workshop. You have, in this case, looks like there's 8 pieces of equipment, 2 lathes, 2 planes, 2 saws, 2 sanders, and you're producing some sort of wood product, wood-based product, tables or chairs, and that would be your fixed plant. You're going to add more workers. Maybe if you have 8 workers, that's pretty good. If you add 4 more workers and 4 more workers after that, now they're waiting to use the equipment, and there's more and more wood laying around and whatever other raw materials you use in component parts, and it gets overcrowded at some point. Your fixed plant begins to constrain you the more variable resources you add to the fixed plant. And output will increase, but by smaller amounts. By the way, you will get to the point where if you hire 1 more worker, output actually goes down. Marginal product can be negative, and it will be negative, because there is some point where hire 1 more worker, and now it's really getting to be a problem, and they're producing less than before you hired that worker. This is the example that's in your textbook, and we will go over this in Chapter 7, Part B. See you there!